Good morning, ladies and gentlemen, and welcome to the show. Today is Tuesday, the 16th of March, 2021. Thank you for tuning in. U.S. retail sales are down 3% across the board right now. Now, they're blaming it on the weather, and yes, we have had some really nasty weather move through Texas, and we've had a giant blizzard that's went through quite recently, and it does keep people home and keep people from buying things, the weather. But, the checks are going out, stimmy checks. Anyway, let's get started. Let's open up the charts right here and take a look. U.S. retail sales dropped 3% in February before a new round of stimulus checks. When those stimmy checks hit the fan and they get out there, it's going to increase retail sales, probably come back up that 3% we've lost. But this is affecting the markets today. This drop of 3% in the in retail sales, because the United States is a consumer-driven economy, and retail sales is what makes up this the drive. 3% is quite a large drop in retail sales across the United States today. Now we're going to take a look at silver today. Silver's dipsy-doodling up and down, but it's down 29 cents on the day at $25.95 today for silver. Let's take a look at gold today. Gold is $17.33. It's up $2.50 on the day so far. So we're back to widening that spread again with the gold to silver ratio. That can't last. The fact that gold's going up a little bit higher than silver today and silver's dropping, that's widening that spread back again. That was an anomaly within the financial system. The fact that silver got up to, what was it, 110 to 1? I think it was at its peak, something like that. And now it's dropped back a little bit. But the normal for a gold to silver ratio is probably around 35 to 1 or 40 to 1. That's normal. We've been in an abnormal period of the gold to silver ratio for a while now. And it's not going to last forever. It's one of those things, Let's take a look now at cryptocurrencies. And we're looking at an industry of 1,700 billion. 1,713 billion for the industry, with a Bitcoin dominance of 60.7%, and we're looking at a Bitcoin price of 55,615 today. Last night, it was really rocking up there high. It was over 60,000 last night. Now it's dropped off today again. But I'll tell you about crypto. Crypto is not something that's going to go to zero. These guys out there who are saying crypto is going to go to zero, maybe they want to buy it when it's at Bitcoin did go to zero. I remember once, when Bitcoin wasn't worth very much, and it did drop down. I think it did drop down to zero for a little while, and come right back. It was only like 2 seconds. Went down, and then it come back up again. I'll tell you, imagine the people buying them back then. Somebody's got 1 million Bitcoins out there. Somebody. Satoshi, whoever he is. Now, that's 1 million we know about, but that entity, Satoshi, whoever or whatever that is, has got the 1 million Bitcoins in a Bitcoin wallet someplace. How do we know? First off, we don't know who they are. And the next thing is, how do we know that they haven't got 2 or 3 million more that they acquired back when they were a nickel apiece? Okay, Dow Jones Industrial Average today, 32,842. It's down today, but you know what? I think a lot of this number today is caused by the U.S. retail sales number coming in, a bad retail sales number. So we're looking at 32,842 on the Dow. If we take a look at oil today, it's off $1.28. And so it's at $64.11 for oil. We get right in there. We're going to take a look at the move index today. We're looking at 70.79 for the move index, and the move index is going along sideways right now. It was down in the 40s. You know, if it gets over 75, it starts to we start to see the beginnings of instability in the credit markets. When the move index crosses 100, then we're seeing more instability, much more, and they will react. Two things they're going to react to. Have no doubt about it in your mind at all, and that's the move index of bonds. Let's take a look at bonds today, and we're seeing a kind of a mixed bag. We're seeing fallen yields mostly, except for the U.S. 20-year. The U.S. 20-year, the yields are rising just a little bit. We got to watch these bonds like a hawk. My tendency is to think that if we take a look at the U.S. 10-year here, and we chart it out over the last few months, let's go back to a 3-month chart here, or let's go back even longer. Let's go back to the 6-month chart, and we chart it out over 6 months. Let's pull this chart back a little bit so you can see it. Yes, it goes up, sets a new high, and then it falls. Then it goes up, surges. It surges. Look, right here. It surged, and then it fell, and then it surged up, and then it fell, and then it surged up, and then it fell here again. And it surged up, and then it fell. It surged up, and then it fell. Okay, so what do you think it's going to do? Now, you've seen over the past few months, it surges up, and then it falls. Surges up and 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 falls right now. What is it going to do next? Okay, what's the most likely thing for it to do next, I should say? Well, it's in the fall mode right now. It's taking the heat off a little bit, right? It hasn't fell that far. It's fell down to 1.59. I think it's getting ready for another surge move. That's what I think. If it surges past 160, it's going to start to head toward 2%. If that happens, we could get some sort of a calamitous event occur within the financial system due to instability within the credit markets that could come very quickly, and it could look very much like what happened in 2008. And it could come very suddenly. Very difficult for the Fed to react to because it would come so fast if this thing surges up past 2%. And I think that's what it's going to do, because you can see it's done these surge moves. Surge up, fall back. Surge up, fall back. We're in the fall back right now. It's done this, let's see, over the past few months, it's done this like once, twice, 3 times, 4 times, 5 times, and it's in the process of doing it the 6th time in a row. So this is what I'm expecting. I'm expecting it to surge. I don't know exactly when, but well, this is a very big threat to the financial system until these are brought under control by the Fed. This is a tremendous threat. Okay, we're going to take a look at the dollar index today. U.S. dollar index, 91.93. See the dollar going along basically sideways, but it's surging up right now a little bit. And we're going to talk about COVID just for a minute. This is a COVID chart. I'm going to bring the charts in so you guys can see this. Let me bring the charts in close. We're just going to focus on this. What's wrong with these charts? Just give me a second here. Okay, there we go. We're getting a close look at it now. We can see that we peaked in around January or so, and now we're dropping off, and we're dropping off quite nicely. Less and less of it out there. It's moving away. It's on its way out, going, you know, and that's a good thing. Let's take a look at Europe, though. Okay, and so this is the chart we want to focus on here in Europe right here, this one. They're very similar. If we take a look at the United States, this chart again, just a sec. Okay, and now we go and we take a look at Europe's. Very similar with this enormous peak right here, and then a fall off. But now they're going up again a little bit. They're having a little bounce back in Europe. My tendency is to think that that bounce back's not going to last too much longer, and it's going to start to fall off again in Europe too, I think. Now that's my opinion only, you know. We're going to have to wait and see what actually happens, you know, but we can see the overall tendency movement. If just looking at charts and understanding how charts work, and you can chart anything. Charts generally, they can follow any commodity, or they can even follow a disease, you know. But they generally perform. You get used to looking at enough charts. In the end, you can almost tell which way a chart's momentum is taking it, you know. And in this case, even though the case mounts are going up right now, it's looking at what I know about charts. I think its tendency is a downwards motion ever since they peaked. They peaked right there. What was it? They peaked around, what was it, November 6th, I guess? Let's see. It's showing me there. Around November 6th. And then they formed another peak in January 8th. And now they're going up, and looks like it's going to form another new peak, and then it's going to continue probably declining. So that's what we see going on with COVID in the world. COVID it's on its downward trend now, basically. And unless we get another big giant wave somehow, and I don't see that happening with the shots going out, I think COVID's going to continue to be on the decline. This means that the worldwide economy is going to start to breathe new life into it again. Especially as we move toward summer. And you know, the viruses tend to decline in summer, and I'm going to tell you, viruses can stick to surfaces. Somebody blows their nose or whatever, they touch something, you know, and it can stick to surfaces. And it mostly stays alive as long as it's like wet on the surface, you know, the droplets and stuff, you know. But when warm, hot summer weather comes in the summertime, it dries all that out really quick. And the sunshine, you know, and the heat tends to kill the viruses off, you know. And we got summer coming. So I've been predicting this for a while, that the economy is going to start to revive again worldwide, moving into summer. This is only going to increase the inflation risk big time, because people will get out there and start spending money and everything again, you know, and the velocity of money could start to go upwards. Especially since they've printed, what, 25%, added 25% more to the money supply? Well, you add 25% more money supply, you should see at least 25% more inflation. But that's not all. When people start to see prices go up massively fast, what they do is they decide they're going to spend if they have the money to spend, you know. Anyway, so U.S. retail sales are down right now. I'm not expecting this to last real long. I'll open the chart a little bit again. I'm expecting this to be kind of a situation that moving in toward summer, I'm expecting resale sales to pick back up again, you know. But we're heading toward an enormous disaster, guys. Let me turn the charts off. We're heading toward an enormous disaster in the world. And it's called hyperinflation. And what it does is, it begins with a loss of confidence in the purchasing power of these fiat currencies. And it all goes back to 1971, when the currencies were pegged to gold. The United States dollar was pegged to gold, and all of the other currencies of the world were pegged to the United States dollar, and it had a good fundamental base behind it, gold. Then they said, well, temporarily, Nixon said, we're going to take us off the gold standard, temporarily. There's no temporarily about it. It's lasted from then until now, from 1971 until now. And this means that all of the world's currencies are not pegged by anything. They don't have any value. They're worthless. But if the central banks have acted in a prudent way and not overprinted these fiat currencies, This, even though they're worthless, people's confidence in them would remain. And this could go on indefinitely with the fiat currencies having value and able to use in commerce and in trade if they had managed them properly. But they're not managing them properly. They are just basically using them as tools, the politicians and stuff, so that they can get reelected and stuff, and they just constantly dipping into that honeypot. They're constantly printing more and more of these fiat currencies, and the fiat currency's value is disintegrating more and more. And we can see it. If we look back a few years, think to yourself when you used to go to the grocery store, like, back maybe 20 years ago, and how much groceries you used to get for like $100. Heck, you'd fill the cart right up and maybe half fill another cart for $100. Now you go in and that little section in the cart where the kitty sits, you fill that and it's $100 now. And it would probably cost you $600 or $700 to fill 2 carts. This is definitely going to erode people's confidence in the purchasing power of these, when they can actually see the purchasing power diminishing. And when it starts to go even faster, prices start to go up quicker, people say to themselves, gee, I better buy that now, because if I wait 6 months, I'm going to pay double. Who knows what you want to buy? But maybe you've been looking at it on Amazon. It's on your wish list or whatever. You're saying to yourself, hey, I want to buy that, whatever it is. And 2 weeks ago, you looked on there and you've seen it go up in price 10% in the last 2 weeks. You think to yourself, hey, maybe I'll borrow the money or whatever, but I need to buy that because maybe 6 months from now it might double in price. And when this start thinking this way starts to go through the general population, this is when you see the savers start to think twice about saving, because they know that their money is going to lose almost 100% of its value in the next 2 years that's in the bank. And this is why your rates are going up on your bonds, treasuries, because people look at the treasuries and say, well, okay, I'm going to invest my money for 10 years in a U.S. 10-year bond, and I'm going to get what rate of interest? 1 point something percent a year? They think to themselves, will my money a year from now only buy 90? Will it buy 99% of what it'll buy this year? And the real truth of the matter is it'll probably only buy 60%. So you've lost 40% of your purchasing power in a year. And they're going to settle with you for this, 1.5%? You're losing a lot of money. And so, in a fair world, that treasury would have to pay you the loss in your purchasing power. So right now, for the U.S. 10-year to pay the loss in your purchasing power, to let them hold that money for 10 years, it would probably have to pay 30 or 40% a year. Quite seriously, for you to be able to purchase next year exactly what you could purchase this year, it's probably 30 or 40%. Wait a year and you'll see. It might be even worse than that. An awful lot of items you buy out there are going to double in price in the next year. So it makes the treasury a joke. So the treasury, no wonder the treasury's going up. No wonder the yields are going up. And the only way it's going to come back down and stabilize is if the Fed uses a hard hand and says, okay, we're not going to let these treasury yields rise. Well, if they do that, then nobody's going to buy them. Except for the Fed. So this means they'll have to increase their balance sheet even higher, And we've got investors worldwide looking at this balance sheet and saying shaking their heads and saying, this is totally gone beyond reason. And they're losing confidence one by one. They're losing confidence. And this is going to turn into a massive loss of confidence worldwide. It's coming, guys. And it's not going to be pretty because your wages are not going to keep up with this inflation. This inflation is going to go faster than the Fed could ever imagine. And you know, this whole thing about a 2% inflation target. And, oh, we'll let it run a little bit hotter than 2%. A little bit hotter? It's going to go to 100% a month. You know? 2%. That's a joke. Per year? That's a joke. 100% per year would be a joke. It's going to go beyond that. It's going to start going into, like, overdrive. They're not going to be able to control that. They think they can dial that like you dial a furnace thermostat, and they can set it right where they want it, and it won't jump past that. Oh, they're joking themselves. It's coming, guys. Listen, guys, thank you for listening to my show. Like and subscribe. Hit that notification bell, and we'll catch you guys in the next episode. Bye-bye.